Welcome. Happy, what are we at? Wednesday, everybody on the Facebook Live watching this. Excited to be talking again about the Elite Growth Academy. We've got it coming up in June. And I'm excited to kick off this live series with one of the speakers and a phenomenal expert in the virtual family office, who Jenna's going to formally introduce here in a moment. But I've had an opportunity just to dive deep into Darren's material. And when you talk about an expert in a niche area, I mean, he really has not only a phenomenal background, but clearly a good passion and understanding for the space. So it's a pleasure to have him with us today. I'm really excited for everybody to get a chance to meet him in person in Nashville. And if you're not going to be there, to at least learn from some of the education that we've got coming up with Darren. So let's introduce him. But Jenna, maybe before that, you can just do a little bit more of a formal and appropriate bio.
Sure can. My pleasure. So Darren Sugiyama started his own employee benefits firm in 2003 called Apex, and then later founded Lionsmart Capital in 2016, which is now one of the most dominant premium financing intermediary firms in the life insurance industry. He's also an internationally acclaimed 8-time author, business coach, and mentor. So very excited to introduce him to all of our attendees. Darren, what can they expect to hear from you this June in Nashville?
Yeah, first of all, thanks for having me here. I knew you guys were going to say such nice things about me. We should be doing Facebook Live every morning.
Yeah. It's a great way to start the day.
Yeah, no, we'll be talking about several different ways that we finance life insurance premiums. We're definitely not a one-trick pony. Every client is going to be in a different situation, both from a net worth standpoint, liquidity standpoint, risk tolerance standpoint. And so we have a variety of different financing platforms. I know one of the biggest questions I'm getting asked right now is, how do we feel about the rising borrowing interest rates, and how is that going to affect premium financing? So we'll definitely be discussing that. I actually believe that that's going to create a lot of really great opportunities, and is really going to, I think, highlight who is doing premium financing properly versus who is doing it, I'll just call it, improperly. So we believe in responsible leverage, and there's a lot of programs out there that we believe are very irresponsible. And so we do this through this very sophisticated method of back testing. We have some proprietary software where we can really communicate to the advisors, the clients, as well as their CPAs, in what circumstances premium financing is appropriate, and what circumstances perhaps premium financing is not appropriate for the client. So we'll be going through a lot of case studies and a lot of good material.
Love it. So I love that you went there in terms of referencing some inappropriate use of premium financing. I remember originally being introduced to it. For me, it was in 2008, roughly. I was working at a smaller boutique firm in San Diego, high net worth clients, business owners, and premium financing was like all the rave. We were doing the dinner workshops and just a lot of premium finance business, until I think it got a little bit too aggressive in that space, probably people cutting corners and a lot of like overnight experts coming up. So can you speak to maybe some of what's changed and what you've seen over the last, 10 years, 12 years in specifically that niche?
Absolutely. Premium financing is not all that different than financing the purchase of other valuable assets, like real estate, for example. And you brought up a great point. You look at 2008 as the world kind of changed again during that period of time. And I believe the world's going to change again the next year or two here in that regard. I oftentimes will ask people that are looking at these overly egregiously aggressive premium financing type of designs. And I say, if you could go back to 2006 and buy a bunch of real estate with no money down, with a negative amortization mortgage loan where you're accruing interest and doing all kinds of crazy stuff, would you go back and do that? 99.9% of the people out there are going to say, no, there's no way I would do that. And so, well, that's kind of what's happening now in the premium financing space, is you have some folks that are going out there and preaching that you can get quote unquote free insurance with no money down, no money in, and try to play the positive arbitrage game. And to use a real estate analogy, if you had done that, say, in the year 2000 and sold in 2004, you might have done pretty darn well, but you would have been lucky. And for the people that tried to do that in 2006 and then kind of got their butt handed to them in 2008, they felt the pain of not being able to weather that sort of storm. So some of those riskier premium financing programs, I guess you could argue that the client is an adult and they're making an informed decision based on what they can tolerate when it comes to risk. But I would say for the large majority of folks that got burned in the mortgage crisis are about to get burned again in the premium financing space if it is done what we call incorrectly or irresponsibly.
Yep, I completely agree. And as professionals, it's like you don't want to attach your reputation and your license and your business that you've worked hard to do to something that you will only have happy clients if they get lucky with timing. It's just not a responsible or sustainable way to grow your practice. So you touched on very briefly the software that you've created, and that's one of the things I think I've been really impressed with. And I know a lot of the more engineer type or CPA focused minds that want detail have really liked about what you've created within your kind of premium financing ecosystem. Can you elaborate on that a little bit of just why you created it, what the feedback is that you've gotten, what's unique about it?
Sure. The large majority of people that talk about premium financing, whether they be so-called premium financing experts or life insurance agents or investment advisors or even clients, they will often say, well, I feel this way about it, or I think that this is reasonable or unreasonable when it comes to assumptions. The problem with all those things that I just said, feeling, there is no feeling in math. Okay? There is no I think this is going to happen in the future. If there was a crystal ball that existed, that might be a logical thing to say, but there is no crystal ball. And so what I wanted to do was transparently find out for my own sanity, when would a premium financing arrangement work, and under what circumstances might it not work? The problem with the way that it has been done for the last few decades is that the premium financier will run the carrier illustration at a certain index crediting rate, and the borrowing rate just so happens to conveniently be less than the crediting rate. Well, it doesn't take a rocket science to figure out that if you're illustrating at 5.5 and the cost of capital is 5, you've got a 50 basis point arbitrage. But that's not the way the real world works. So what we did is we went back and we actually modeled, this is going to sound like overkill, we modeled 121 different 40-year historical windows of the S&P 500 performance. And so what our software does is we put all the inputs in and apply the carrier's charges methods and crediting methods, including all the asset-based charges, if there are any additional asset-based charges that coincide with multiplier bonuses. And so when we backtest this through 121 different 40-year windows, I like to focus on the 40-year window that produced the worst compounded annual growth rate out of 121 different 40-year periods. I think that's a pretty conservative benchmark to kind of base our risk assumptions on. So when we do that, depending on what the carrier's product's floor and cap is, and again, crediting methods and charges methods, we'll create what we call a proxy. So we're not recreating a carrier illustration, we're creating a proxy for this product that behaves like, in this case, an IUL as an example. So we can see in times of volatility when a 40-year sequence experiences a really negative sequence of returns. In other words, when the first 10 years starts off really awful, we can see what happens with the simulated cash value in this proxy as it pertains to the lending mechanism, right? So how much is the cost of capital versus how is the simulated cash value performing? And we can get a real clear understanding, or the client can get a real clear understanding of what circumstances a premium financing arrangement would prove positive and when it wouldn't. So we run every single model with every single client through these 121 different 40-year periods. I think that's a pretty, again, maybe it's overkill. I think it's better to know what a range of outcomes might be, as opposed to just assuming a static, say 5.5% index credit as an example. I
think absolutely it's more fair to the client. I mean, the more education more educated the decision. It's definitely the real right way to do it. Just one more thought that comes to mind. So obviously I know through our work, a number of the books that you've written have been focused on premium financing, the proprietary software you've developed. If you look at, your YouTube video or a number of your websites, like there's a lot of content, obviously a lot of time and energy you've invested into that niche. So kind of a off the cuff question, but why premium financing? Why is it something that you're clearly so focused on and so much passion around?
Yeah, so I got introduced to premium financing as a client before I got into the premium financing space. I've been in the insurance space since 2003, so almost 20 years in. I started out in the employee benefits space about 5 years into me building my first firm, literally out of a hotel lobby because I was broke and couldn't afford a proper office back then. We built a firm. By the time we hit my 5th year, we were #1 in the country with 3 different carriers concurrently. By my 7th year, we were doing just over 37 million in annual premium. And I was in my mid 30s, what I call a kid now, because I'm an old man now. But back then, I didn't know what to do with my money. So I hired this so-called financial advisor. And I'll make a real long story short. Part of this tax planning strategy was to purchase 17 life insurance policies, a large one on me and 16 of them on my people. And to make a real long story short, after I hired a tax attorney to come in and do an internal audit and explain to me what this guy had done, the attorney comes to me and says, "I got bad news. Your plan is completely out of compliance. You have to unwind the whole thing. You're $600,000 in premium deep into these policies. You have 0 surrender value. And on top of that, all that, you owe the IRS in the state of California $330,000 in back taxes, penalties, and interest." So that's how I learned about that's how I learned about cash value life insurance. It was very embarrassing, quite frankly, to go through that because I like to pride myself in being a relatively intelligent person, but I had no idea what the so-called financial advisor was doing behind the scenes. After getting burned with that, that's when I got into the life insurance space and started a life insurance agency. Back then, we would usually hover between 45 to 50 agents under one roof in my office in Orange County, California. We had six very small satellite offices sprinkled out throughout the country, and we were doing a pretty substantial amount of volume. But then when I got into the premium financing space, which was kind of an organic process just from being in the life insurance space, we realized that not only did these business owner clients not understand how the actual life insurance product chassis worked, crediting charges, et cetera. When it got into the financing, they didn't understand the banking side either. And so again, being able to take a real educationally based process and put that into a space where everyone is quote unquote selling, we seek to help the client have a better and deeper understanding of what's going on. Once they understand the process and understand the mathematics of it all, it's very difficult for them to say no because the math proves positive if done properly. So again, we take more of a mathematical / educational approach to everything. And by the way, in my previous life before I got into business, I was a high school teacher in Hawaii. So maybe that's where maybe I'm still a teacher at heart. The pay is a little better now, though. Just a little bit.
Both my parents are retired teachers as well as my sister. So you and I both have that in our blood somewhere. I love that. Thank you for sharing that. So just as we're wrapping up, any last thoughts that our guests coming out to Nashville should anticipate in your presentation or the discussion?
I don't pull any punches, and I speak very bluntly. And if something is garbage, I'm going to call it garbage. And if something's great, I'm going to call it great. The thing about premium financing, to use a golf analogy, if it's designed properly, let the club do the work. You don't need to put all this extra stuff. You don't need to put extra mustard on the hot dog. You don't need to put extra, crema on the taco. I mean, it's a very mathematically prudent thing to do for the right client if designed properly. If designed improperly, where people are getting greedy and egregiously aggressive in their assumptions, It's again as dangerous as going back to 2006 and getting into some crazy mortgage that is not well suited or not well designed for that specific client.
Yeah.
So that's we're going to see the truth. I guess is we're going to see the truth.
See the truth. That's the promise.
it.
Well,
Yeah.
I love that.
Imagine that. Imagine that transparency and truth in the life insurance space. Oh my God, what a revelation.
Love it. All right. Well, I'm excited. I know, Jenna, we got to wrap.
Yeah.
Do you want to share the dates and the link just to make sure people have that information?
Of course. So if you are a growth-minded advisor accountant, you want to see Darren in Nashville in person this June, it is June 23rd and 24th. You can go to elitegrowthacademy.com to reserve your seat today. So really looking forward to it. Thank you so much for your time today, Darren. We really appreciate it.
Thank you very much, Darren.
Thanks, everyone.
Thanks, everyone. See everyone soon.